This is Dr. Murray with Boosted Profits, and I want to take a few minutes to cut this quick video as I try to get the word out to explain why that we have a narrow window in time to take advantage of a tax loophole that was created by the 2017 TCJA tax law changes. And once this window passes, it's gone forever. So let's jump right in. So TCGA is the recent 2017 Tax Reform Act. And as we know, one of the main provisions in that was dropping the corporate tax rate from 35% to 21%. So that's great for income taxed at a lower rate. But there's a drawback that the lower rates mean less deductions, less bang for your buck for each deduction that you claim. So what does that matter? So I'm going to explain to you why we're going to use cost segregation to take advantage of this tax loophole that exists right now. And cost segregation, I'm going to give you a little backdrop. It's a powerful tax remediation strategy. Um, the business value of the property, including renovations, is typically assigned a 39-year cost basis according to tax law. So what that means is most companies, and particularly companies that don't implement cost segregation, write off the cost of the building, the value of the building, using what they call straight line depreciation, meaning every year is the same amount. So every company writes off 1/39th of the value of their property every year as a deduction against their income. Okay, that's totally legal. That's normal. That's what most companies do. But you're losing out if you're not using cost segregation. What cost segregation does is it was implemented to identify the different components of property that are eligible for accelerated depreciation. What does that mean? Well, different components, examples of components would be like HVAC, lighting, plumbing. These things, none of these things necessarily last 39 years, so they're giving a shorter life span, and therefore the value of those components can be written off much quicker. The result is you get a large, and I'm going to emphasize large, one-time immediate cash flow. It's a huge benefit to businesses. It's completely legal and fully supported by the IRS. The best industries that qualify for cost segregation. The top five are auto dealerships, manufacturing, commercial real estate, hotels, and construction, architecture, and engineering. And the reason is because the nature of the business, all those industries have usually large structures and property assets. But they're not the only ones who qualify for cost segregation. Medical facilities, professional services, um, restaurants, rental property owners, any business that owns, not leases, but owns large assets in buildings, plant, and equipment around $750,000 or more are definitely candidates for cost segregation. So here's an example with just a sample commercial real estate property owner with just a number for illustration purposes to give you an idea of the what we're talking about in potential tax savings. So assume a building owned by a business, including renovation, is valued at $4 million on the books. So based on the 2017 rates, we would expect an estimated one-time savings using cost segregation of between 240 and 300K. That's a lot of money, okay, just for the cost segregation process, okay? The reason there's a range here, it depends on some factors like how the building is used, level of build out. It doesn't matter if the building is new or not. You could have bought this 10 years ago. The newer the better, but it doesn't have to be a building that was built or renovated in 2017. It could be an older building. And this can be exercised even if the previous owner had, or if the business has already had a cost segregation study implemented, say, 10 years ago. But if a new business buys the building or a new owner or whatever, um, the clock resets and you can do it again. So if this is so great, why doesn't every business owner use this? What's the deal here? That's a lot of money. They should be doing this. Well, some companies are not aware of the program. Some companies are not aware they qualify, and I'm talking about the owner and the tax professional that supports that owner. Sometimes it's a case where they don't have the bandwidth to implement this strategy, and that's kind of common. It requires an engineering study that might not be within the skill set of the tax professional who supports that business. It could be any number of reasons, but not everybody is using cost segregation. It's far underutilized. I'm going to estimate that there's 90% of potential businesses do not know or are not using this, and they need to look at it. So that cost segregation should be used all the time. It should be used next year, whenever. I mean, you can only do it once per building, but it should always be considered. But I'm going to explain why now, right now, is the exact best time in history to implement this program, because there's a unique situation here. So when we implement cost segregation on a property using the 2017 tax rate of 35%, there's 40% higher cash flow savings because this is a deduction that you're filing against income than they would benefit from if they used the 2018 tax rate of 21%. So let me repeat that. You're going to get a higher deduction by 40% when you file taxes if you use the 2017 rate. And right now, as I record this, which is February 2018, businesses are currently preparing taxes based on their 2017 activity. So in order to capitalize on this loophole in tax rate changes, cost segregation must be implemented in the 2017 tax computation. Waiting until paying 2018 taxes or beyond will result in a lost opportunity. So just the timing of this, whether you wait or do it now, is going to make a big difference. Property and renovations must be complete and on the books by the end of last year to qualify. It doesn't have to be purchased or renovated in 2017. It could, as long as it's on the books. If you're still doing renovation now, and it won't be completed until sometime in 2018, those renovation expenses cannot be considered. It has to be wrapped up by the end of 2017. Age or purchase date of the property is not a factor, as I mentioned. And anytime a property changes hands, the clock is reset. So we mentioned those already. But in the example I just gave on the previous slide, if we wait until 2018 to implement cost segregation for that sample property, they're going to lose somewhere around $100,000 just by waiting. Just by waiting, they're going to lose $100,000. So this is a time-sensitive strategy that they must implement. So my conclusion and my strong recommendation to all U.S. businesses is do not file 2017 taxes without considering the impact of cost segregation. At least consider it. At least get the estimate of what that could save you. Because once this window has passed, the opportunity will be gone. You should still consider cost segregation going forward. I'm not saying you should never do it, but just by doing it in this time, I think I've demonstrated that that's a $100,000 difference in the example I just gave. You probably have existing clients or friends who are unaware of this one-time tax loophole, so get the word out. Tell your tax professional. Tell your clients. Get the word out. And why am I telling you this? Well, we can help if one of your clients or anyone you know needs more understanding of what's going on with the cost segregation study. My company has been performing cost segregation studies and other tax remediation strategies for over 17 years. Now here's the key thing. We can estimate the potential savings in less than 13 minutes with a few questions. There's absolutely zero risk. I repeat, zero risk to the business owner. We only get paid on a contingency basis, and we only get paid a small amount of the actual savings generated. We basically do all the work. If you agree that we should proceed based on the estimate that we provided here in step 2, then we do all the work and you only pay once you've actually achieved the savings. So this is a no-brainer, no risk. We work hand in hand with the client's tax professional. This is full disclosure. This is not top secret stuff. We're not trying to displace the tax professional. We want them to be fully on board and totally understand what we're doing. And to my experience so far, that they've always been very supportive. Now, how does this help you? This is a huge potential value added service to your clients. This is a significant differentiator from your competitors, opens more doors, assists in price negotiations, reduces the attempt to squeeze commissions if you're paid on a commission basis. If you can provide the cash value that I just demonstrated to your clients, they're going to be less inclined to try to squeeze you. So past clients, stay relevant to past clients. Get more business from past clients by sharing this information. Make sure their tax professionals know this. Current clients get a big jump on competitors by offering them cash back and eliminate commission reduction. Future clients, It's projected that $18 million, 18 million businesses are going to be sold, handed down, or closed in the next 8 to 10 years. How many properties is that going to be? Establish relationships with the owners before that happens. This is a huge windfall for you and your clients. If you'd like more information on this, if you'd like to talk about partnering with me and figuring out how we can help you and your clients in a win-win scenario, I'd love to do that. I'd love to get on the phone with you. This is just a no-brainer. I get excited when I can save people taxes. Who wants to pay more taxes than they really need to pay? Here's my contact information, Murray at boostedprofits.com, or we can schedule a call using this link. Either way, I look forward to hearing from you. It's been a pleasure, and make sure you don't pay more taxes than you need to. I look forward to hearing from you. This is Murray at boostedprofits.com.